September 3, 1929. The Dow Jones hit its all-time high, 381 points. Roger Babson had warned of a crash just days before. The Wall Street Journal called his warning absurd. 55 days later, the Dow had fallen 40%. The warnings were there. Nobody stopped. By 1929, the American stock market had risen 400% in 7 years. Price-to-earnings ratios were at historic extremes. Margin debt, money borrowed to buy stocks, had tripled since 1925. Investors were buying stocks with borrowed money, betting that prices would keep rising. The Federal Reserve had raised interest rates twice in 1929 to cool speculative excess. Instead of cooling, the market kept rising, until September 3rd, when it stopped. Here is the paradox the historical record documents. The warnings were not hidden. Roger Babson warned publicly in September 1929. The Economist magazine had been writing about overvaluation since 1928. The Fed had raised rates specifically because of speculative excess. Every institutional mechanism designed to slow a bubble was deployed. The bubble continued for months after the warnings, then collapsed in weeks. The paradox: the market does not correct when the warning is issued. It corrects when confidence breaks. And confidence can persist long after the rational case for it has ended. The crash of October 29, 1929, Black Tuesday, was not caused by new bad news. It was caused by the exhaustion of confidence itself. Oil hit $141 per barrel this week. The IEA warned April will be worse than March. The S&P 500 has opened Monday on a jobs report that came in far better than expected at 178,000. The market can rally on good news, even when structural conditions are deteriorating. The data from 1929 suggests that the gap between warnings and corrections is measured in confidence, not in data. If the 1929 warnings were accurate but early by months, and accuracy without timing is indistinguishable from being wrong, what is the value of a correct warning?